Catalina today, coming to you with explaining how interest on your student loan is calculated, along with what the interest implications mean if you go on to an income-driven repayment plan. What is happening to your interest? And I want to end with why, as a result of your interest, why is filing, if you go into an income-driven repayment plan, so important to not having interest capitalized? I'll explain what that means as well. And then lastly, I want to, of course, end with pro tips on what you could do to best manage your student loan plans, and as well as the implications on other financial goals by managing your student loans well. So that's 3 segments of this video. I'm going to screen share so we can speak very clearly about the interest that's accumulating with specifics, okay? So let's say you have $40,000 of student loans, right? And let's say it's at 6% interest. So that means approximately, let me move this down, that approximately $2,400 of interest is accumulating annually. On a daily interest basis, how that's calculated is it's the 2,400 divided by, excuse me for looking down at my keyboard, which comes to approximately $6.50. Okay, it's like 57 cents or something. That's your daily accumulating interest. It's really, really important and good to know that number, because you wake up every morning and you're like breathing, oh my God, I have to pay $6.57 of interest today. So that's like a really expensive latte or the majority of a lunch, right? So keep that in mind. On a monthly basis, the amount of accumulating interest you are accruing is $200. So that's really important to know. So now let's talk about if you go into an income-driven repayment plan, right? Income-driven repayment plan covers income-based repayment, revised pay-as-you-earn, and pay-as-you-earn. And the difference between those plans is that it treats this accumulating interest differently. I'm not going to go into all the specifics about how it treats the interest differently. I will save that for another video. This video, I'm just going to explain in general what happens to the accumulating interest. So let's say now you go on to an IDR plan, right? It could be any of the plans I just mentioned. They all calculate how much your payment should be differently, and they have different rules around calculating that, as well as how the interest works. But let's just say your payment is $100, okay? So it's obviously less than the accumulating interest. This is where it gets interesting, and this is what I want to explain, because this is where people get confused. So let's say this $40,000 balance, right? Let's pretend you had all subsidized loans, so no interest accumulated until you hit the repayment period, okay? So let's say you now have, now I'm going to create another column here so we could keep it organized and separate. Let's say you have this $40,000 of principal, sorry, 40,000, I can't type. And now you have 2,400 of interest accumulating, but you're only paying 1,200. So what ends up happening is you have $40,000, but you now will owe 1,200 because you've paid down only 1,200 of interest. So now you'll have 1,200. Let's say the next year goes by. So now you'll owe 41,200, right? Next year goes by, let's say, just for simplicity, you have the same loan payment, $100, and you'll have another 24, you'll have this by now, it will be 41,200, right? But I'm going to keep the interest separate so we can understand what's happening. You will have 1,200 plus 2,400 accumulate. That will be 3,600, right? But then you're going to minus the 1,200, right? Because that's how much you paid in from the $100 a month. So that means that you will now owe, it's now grown again to 2,400, right? So it looks like your balance isn't going down. And if we keep on repeating that, your balance is actually going up by $1,200. And that really, really worries people, right? Because they're like, oh my gosh, my balance is going down. This is why filing into the income-driven plan and filing the paperwork annually is so important, because what happens is the act of filing is telling the government, I want this accumulating interest forgiven, okay? And what the IDR plan does is it establishes the rules of how much of this interest accumulates, right? So for the first 3 years, that accumulating interest, the government will pay 100% of. So this amount you see here of 2,400, the first 3 years of repayment, which I did this example, the government will 100% cover the interest on all of the plans if it's subsidized loans. After the 3 years, all the plans will subsidize interest at different rates. Like revised pay as you earn will pay 50% of the interest. So let's say you pay 1,200, you have 2,400 accumulating, the government will still cover 50% of that interest, so only 600 will accumulate, okay? So that's an example. Filing and continuing to file is so important because it's telling the government, keep on subsidizing my interest, please, so it doesn't keep on going up and up and up. Another thing filing does is the total loan balance at the end of your repayment period, whether it's 10 years because you're a public servant, or whether it's 20 years because you're a private sector employee, or 25 because you went to grad school. There's different factors that calculate into this. The government will say, okay, anything you don't pay after that is forgiven. So even if the balance still stays at $40,000, you will get $40,000 of forgiveness as long as you have made your monthly payments and continue to file the paperwork. The number one error people commit is they're like, oh, well, I want to pay faster, I'm going to stop filing. That is a huge error, because what ends up happening is all that accumulating interest that the government would forgive now capitalizes, which means it goes on top of the principal. So now instead of 40,000, now you're going to have $42,400. But let's say you've done this for years and years and years, and 10,000, like you have more accumulating. Then what will happen is now you actually owe physically a higher principal balance, which means more interest is accumulating on a monthly basis. So if you have $42,000 in this formula, more interest is accumulating every single day. So instead of $6, it might jump to $8 of interest accumulating, right? It's really important that you don't let the interest capitalize, because then more interest will accumulate. So that's why filing the paperwork is so important, even if you want to pay your loans off quicker. People are like, oh, I got a better paying job, I don't want to do an income-driven repayment plan anymore. It does not matter. You have to continue to file or your interest will capitalize. There are 3 circumstances under which your interest will capitalize. You stop enrolling or stop enrolling on time. You consolidate your student loans. You do not want to consolidate your student loans willy-nilly without thinking about it. And then, of course, if you refinance your student loans and privatize it, it'll take all that interest, add on top of the principal, and make a new loan, okay? And then lastly, if you change loan plans. So for example, let's say you're on an IDR and you're like, oh, I don't really want it, I want to go on to an extended repayment. Well, guess what? That interest will now capitalize, okay? So be very careful of the actions and how you manage your student loans, because it can literally dictate whether you pay back, $20,000 or whether you pay back $80,000 based on borrowing $40,000. Okay. So it's really, really, really important that you manage your student loans well. It also has huge implications, because if your interest capitalizes, let's say somebody the other day took out about 40 grand, they came to us and they ended up having 20 grand capitalized, okay, because they were paying for years. So then they ended up now owing 60,000. So they went to try to get a mortgage and the lender calculated 1%. So now $600 counted towards their debt to income instead of $400, okay? So it's really, that matters to how much house you can afford, right? And that matters to the tune of about $40,000 more house you can afford if you didn't have that interest capitalized. So it's really, really important. By the way, when you get married, when you have children, that all affects your student loan repayment amount, as well as, it affects how much you have to pay back, what the requirements are to file. And so it's really, really important that when you, even saving for retirement, for example, even affects how much saving for retirement reduces your student loan payment. So all these different things you do with your finances affects your student loans. And it's really important to understand that, get a plan, and know when you need to refile, when's best to refile, what your overall strategy is, and how to manage that strategy. And that's what we do at LoanSense. We not just help you manage your student loan decisions, we help manage your paperwork, and we help manage how your student loans impact other financial decisions like buying a home, retirement, etc. We understand mortgage credit rules. We help you leave with a home buying plan even. So if you believe this could be helpful, please do not hesitate to get started at My LoanSense. If you like our content, please subscribe, hit the like button, leave your questions, comments. Love to answer them. Thanks.